Good morning, everyone. Hello and welcome to ESG Playbook's webinar on demystifying the EU taxonomy. Thank you all for joining. I am Sonia Zugel, the CEO and founder of ESG Playbook. ESG Playbook started in 2019 as I saw a need for a one-stop shop for all ESG reporting, including addressing EU regulations. Currently, we have 9 reporting modules. We also have a consultants dashboard, as we see consultants as a very important part of understanding the ever-changing ESG reporting and regulation space. Our agenda for today is explaining the webinar content layout, EU taxonomy overview, who needs to report and when, breaking down the steps to report, case study on real estate, and Q&A. We will be highlighting both how to report on financial as well as non-financial sectors. We have 3 speakers today. We have Ian, who is our Senior Solutions Engineer, Bella, Head of Research, both from the ESG Playbook team, and Vasarė, who is a consultant for Northern Horizon, a real estate asset management firm in Europe, who already has prepared an EU taxonomy report last year. Before we begin, a little housekeeping. We are recording the webinar and will email the recording to all those who have registered. After our presentation, we will open it up to Q&A. Should you have any questions, even as we go along, please put them in the chat and we will answer them as many as possible at the end. Any questions we do not have time for, please reach out to us and we're happy to help. Over to you, Ian.
Okay, thank you, Sonia, for the introduction. And before we get to the content of today's webinar, I do want to talk about the flow and the layout. So at the very top, we'll have our major topics that we're going to be covering today. They'll be grayed out and highlighted as the webinar progresses, so we can keep track of where we are. And on the left side, we have our minor topics. Since each major topic at the top has a set of minor topics to the side, the content today is going to be quite dense. So it's set up this way to make each portion a little bit more digestible. And with that in mind, we can begin. So the EU taxonomy overview, first and foremost, we're going to have to understand what the EU taxonomy is. The EU taxonomy provides a classification system or framework to create a common language for sustainable finance and corporate sustainability. It was developed to provide investors with enough information to compare companies' sustainability disclosure and performance. Ultimately, the EU taxonomy is a report that prevents companies from greenwashing. And this is done so by having the companies follow a set of criteria that are laid out within 6 defined environmental objectives. These objectives are the climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution and prevention control, and protection and restoration of biodiversity and ecosystems. So before we get even farther in, we do have a couple of key terms to address first. Although this webinar is in reference to the EU taxonomy, we will mention a few other regulations and directives as well, since the regulations stem from or lead into these other regulations and directives. First, we have the Non-Financial Reporting Directive, or the NFRD. This defines who is applicable to report on the EU taxonomy. Next, we have the Sustainable Finance Disclosure Regulation, or the SFDR. This is an EU regulatory report for financial companies, which also does then require an EU taxonomy report. And then we have the Corporate Sustainability Reporting Directive, or the CSRD. This is an upcoming expansion to the NFRD, presenting more stringency to the EU taxonomy regulations in terms of assurance, and also expanding the scope of who is included to report. Another set of key terms is towards the assessment side. The assessments involved in the EU taxonomy are defined by sectors and activities. The sectors are EU taxonomy defined and contain groups of EU taxonomy activities. But within each set of activities, there are a list of mapped NACE codes or NACE codes, where NACE acts as a framework to group businesses into these economic activities, and it's entirely a different classification system. So these NACE codes are then broken up from high level to low level using a term called level. Now, normally there are 4 NACE levels, but with NACE level 1 being the highest level of NACE section, we already have the EU taxonomy sectors. So those wouldn't necessarily apply to our EU taxonomy. We'll be focusing more on these 3. NACE level 2, these are the high level activities to display a general grouping. And this is where the EU taxonomy's activities are used as a guide from. The NACE level 3s, which are sort of mid-level contained within each level 2. And then we have our NACE level 4. These are the more detailed level economic activities that are grouped within each level 3. So NACE breaks this down to help companies navigate its own classification system, using each level as a sort of guide to reach those level 4s. Because when we go through the eligibility assessment a little bit later, these level 4s are what we want to map our organization towards. But with a general understanding and some key terms discussed, we can talk more about the specific requirements. Most importantly, who's affected by the new requirements and by when do they need to report? Well, that would be the large public interest companies with 500 more employees. There's a specific definition towards public interest, which we've broken up and simplified. However, for a direct definition, please search for Article 2 and 3 with the directive that you see on the screen. To abbreviate, companies that are subject to the NFRD are obligated to report on the taxonomy. These companies can include banks and insurance companies, regardless of their listing, all public companies, regardless of the purpose of business, and any other company that is designated by the respective member state. These public interest companies to report on the taxonomy then also have to have 500 or more employees and be either based in the EU or conduct business in the EU. The companies must also have a balance sheet of more than 20 million euros or a net turnover of more than 40 million euros, or they have to be part of a parent company that meets those requirements. So if you fall under the scope of the taxonomy, how should you prepare? As we'll go through, you'll see that the taxonomy requires quite a lot of information, especially when starting out. First of all, expect to set aside some time. This is a complicated reporting process. Familiarize yourself with the specific requirements, and keeping up with those regulations is also important as the taxonomy is constantly evolving. And ensure that there are quality data collection methods in place. This is for financial data, assessments, and policies, which are always good to have on hand, or at least have there be a method to gather the data. Explore different kinds of solutions to help. Technological solutions can help extremely well with a lot of the manual work, and consulting companies really help with the understanding of the regulations and all of the work involved. So if you do have to do taxonomy report, and maybe you've done some prep, when should this report be published, and what happens if you miss that deadline? Well, there's not one date for everyone to finalize a report by. It's dependent on your company's financial reporting calendar. Whenever you go to file your financial reports, the EU Taxonomy report should also go with it. And as for penalties for the year of 2023, where we will be reporting on the data from 2022, there are no regulation-specific penalties. There are also no regulation-specific requirements around assuring the report. However, these sort of penalties will come in when the CSRD is finalized for the year of 2025, in which we'll be reporting on the data from 2024. I do say that there's no regulation-specific penalties, but there may be other potential consequences that come along not filing a report. And to clarify, these consequences are not absolute, but rather conjecture, as there can be quite a few factors aside from the regulations that can prompt a taxonomy report. Financial consequences could come in the form of local fines, dependent on the member state. Also, without a report, there may be withholdings from investors, making restriction to capital a real worry. On the social side, there could be backlash from customers until a report is provided. There may also be restriction to talent, as both the current and rising working generation become more environmentally aware. And there are also other regulations in each of these requirements that need to be followed. If the EU taxonomy is part of these other reporting regulations, then failure to produce a taxonomy report can lead to penalties within those other regulations. With all that in mind, I do want to touch on that last point about the other regulations before I go more into the taxonomy's workflow. Now, we've spoken mostly on the taxonomy and how it refers to the large public interest companies, but there is another section of companies that would have to report on a taxonomy. I mentioned the SFDR, and this is a prime example of that. Generally, it's a report on your company's financial investments, which provides a similar transparency towards those investments. As part of the SFDR, you'd also have to submit a taxonomy report on your own company. So SFDR is an annual report, which is currently already in effect, and this is for private or public financial companies, regardless of the size. And as for the CSRD, which is not yet in effect, and will come into play for the year of 2025, again, where you report on the data from 2024, following its requirements, the EU taxonomy will become much more rigid in its assurance, CSRD will also include more companies by expanding the scope to at least 50,000 companies involved in the EU. But with those other regulations in mind, I'd like to invite Bella to talk more on the EU Taxonomy and how it relates to the SFDR. Again, Bella has been working in the ESG Playbook for the past 2.5 years as head of research and has been heavily involved with the EU regulations. Over to you, Bella.
Thanks, Ian. I will explain the implication of EU taxonomy on financial companies, primarily banks, asset managers, insurance and reinsurance companies, and investment firms. So first of all, the requirements and templates for financials are set out in Annex 3 to 10 of the Disclosure Act until financial year 20. Next slide, please. Until financial year 2022, all financial companies only need to report eligibility plus the exposure to certain type of assets. From financial year 2023, they must report the alignment KPIs as well. So the alignment KPI for banks is the green assets ratio, also referred to as GAR. It's calculated as aligned assets divided by total GAR assets. If you look at the chart on the right, it is an example of BNP Paribas assets breakdown and how the GAR is calculated. The numerator is aligned assets. Those are loans, equities, and other assets funding taxonomy aligned economic activities, excluding the exposure to sovereigns and central banks, derivatives, and companies not subject to NFRD and trading books. So the denominator is GR assets. Those are assets in scope, but exclude the exposure to sovereign and central banks. Moving on to the asset managers, green investment ratio should be used to measure the degree of taxonomy alignment. So the value is a weighted average of alignment ratio based on the turnover or CapEx KPIs disclosed by investee companies. The weighted average is the sum of investment weights multiplied by the KPIs. Could be turnover or CapEx. So based on Moody's data, the eligibility and alignment of the major index is still very low at this moment. And also not many asset managers fall in the scope of NFRD. So there is a lack of reporting among asset managers right now. Next slide, please. EU taxonomy also interacts with SFDR at the product level according to Article 5 and 6. So this means financial market participants that offer Article 8 and 9 funds under SFDR are obligated to disclose taxonomy-related information in the pre-contractual and periodical disclosure to showcase the contribution to sustainability objectives. So Article 8 funds are defined as those promote environmental and social characteristics, and Article 9 funds are defined as exclusively invest in sustainable investment. So this pie chart below shows the planned taxonomy-aligned investment based on the final report on RTS proposed by the ESA on September 30th, 2022. So next slide. How does this data roll up to the fund level? So on this slide, you can see how the alignment data at the investee companies level is aggregated based on the weight of the assets under management. Now moving on to the insurance companies, the KPI is still green as investment ratio. However, if the company has non-life insurance and reinsurance business, they need to disclose the alignment of underwriting activities according to Annex 2.10 of the Climate Delegate Act. So on the right, it's a sample report of moon literature. So lastly, I want to touch on the reporting for financials, since the financials companies largely depend on the disclosure of non-financials. So the data is the key to fulfill EU taxonomy reporting. Financial companies can source the data either from a third party and integrate the data via API. Alternatively, they can also use their proprietary tools, such as sending a survey directly to their university companies this is a great way to demonstrate their best efforts as well. So due to the time constraints, I will pause here. I can answer any questions regarding to financials during the Q&A session. So Ian will explain the workflow of EU Taxonomy. Head back to you, Ian.
Thank you, Bella. Now that we have gone and discussed the general overview and the requirements, we can talk towards more what it actually takes to work through a taxonomy report. And there were a couple of extra terms that were added when Bella was discussing the financial section, and we'll go over them as well within the rest of this webinar. And this will be somewhat of a high level, but we will also be explaining some key terms and the general workflow, as well as showing off some examples. So much of the workflow itself is not directly defined by the taxonomy. So how the report is created and the process is taken up by the reporter. With that said, here is a workflow for a taxonomy report. We would start at our eligibility assessment, which is done for those NAICE codes that we find applicable to our organization. Following the alignment assessment for what NAICE codes that were passed on to the previous assessment, passed in the previous assessment, how much of those are actually aligned to the EU taxonomy criteria. After both of those are completed, we can assign our financial data certain statuses or indicators that will help us distribute said financial data to the taxonomy requirements. And finally, we can build out the EU taxonomy report with an improved format. Alongside that, any supporting documentation can be gathered. Again, if it's assurance purposes for the sake of the regulation itself, then it's not necessarily required, but generally just a good practice. And it's those 4 deceptively simple looking steps that we would have to follow to create a report. And I'd like to make a clear distinction before we go ahead, though. There will be references into the term entity throughout the rest of this webinar. The EU taxonomy report is done per legal entity for all NAICE codes within the organization. So all EU taxonomy activities that contain those codes that fall under the taxonomy scope. For example, a single parent company could have multiple legal entities, and the entire organization could be spread out across multiple EU taxonomy sectors with potentially dozens of NAICE codes involved. So depending on the company's size and scope, this can get very complicated very early on in terms of tracking data. But with that in mind, we can continue. At the very beginning, we have our eligibility assessment. Eligibility dictates that an economic activity is described and has criteria finalized in the EU taxonomy. In a more general language, NAICE code, there is a NAICE code that is mapped to the EU taxonomy and has criteria that can be followed. This can also act as a sort of pre-qualification, in a sense, to the alignment assessment. And eligibility is not based purely on the green portions of your company, as the EU taxonomy is to prevent greenwashing in general and provide transparency. Any activity that your company partakes in that is included within the EU taxonomy should also be included in the eligibility assessment, green or otherwise. And to start, you have to map your organization to the available activities within the EU taxonomy. And this can be quite a process, as every activity has a specific definition and its own description that your organization will have to map to. Presented here, we have a video from ESG Playbook's own software on the EU taxonomy that will show the process of how a software could assist with the selection of activities. Now, before I get in, it's important to note that the process of picking activities is easier with the software, with all the designated requirements displayed directly to you, but also that information will continue to flow through the rest of the system. But here we can see the software presenting the relevant EU taxonomy activities dependent on the selected sectors. Now, in this case, we only have one activity picked, but in reality, there may be many more included. Alongside these descriptions, alongside the activities we picked, we now have the NAICE activity or the NAICE codes that are displayed to the respective EU taxonomy activities and sectors. So once we know where we fall within the EU taxonomy, we have to make sure that the activities follow a certain criteria. We first have to make sure the activity is actually in the scope of the EU taxonomy. There have only been 232 NAICE codes that have been mapped so far, but there's roughly about at least 300 codes that have not yet been mapped. So more than half of the NAICE codes still need to be mapped to the taxonomy. These unmapped activities could be high carbon activities, such as coal mining, or activities that don't yet have criteria that are finalized yet. Secondly, we have to make sure that there's any amount of cash flow within the activity. Is there revenue, or are there expenses? If not, then the activity is not eligible because the company doesn't actually do any business in that activity. And this acts as a sort of check to make sure that all activities are financially included within the company. And finally, have we completed any necessary assessments? Assessments for eligibility may be based on the environmental objective, and there are external assessments that need to be completed to meet these requirements. So assuming we follow all these criteria, then we can assume that the activity and the environmental objective is then eligible and can undergo the alignment assessment. Before we get into that step of the alignment side, I'd like to show another example of how eligibility can be defined, provided we have another video demonstration using the previously selected activity as an example. So again, please remember that this activity would only be a small portion of your business, and in this case, we have roofing activities. Because we selected this one, we want to make sure that the relevant environmental objectives of climate change mitigation and adaptation are eligible, and that's done so by responding to presented criteria. So in this first example, both mitigation and adaptation are going to be found to be eligible, resulting in roofing activities also being eligible. But please note that not all criteria for eligibility need to be met for an objective to be eligible, only specific criteria or groups of criteria. In this second example, we're going to end up evaluating mitigation to be non-eligible, as maybe, as per the first question, maybe our involvement in the activity doesn't actually match the description laid out by the EU Taxonomy. In this case, we can see that roofing activities is still eligible because adaptation is also still eligible. However, in this final example, we'll find that adaptation is going to be also not eligible. In this case, we still follow the description laid out by the taxonomy, but the questions that we answered to no are in regards to cash flow. If we answered no to both questions regarding cash flow, then for adaptation, we don't have any cash flow in the activity, and we're not financially involved within the objective. Now, roofing activities is non-eligible because all applicable environmental objectives are also non-eligible. And ultimately, depending on the eligibility from the assessment, roofing activities in this example may or may not have to go through the alignment assessment, which then brings us to our next step, the alignment assessment. And now that we've undergone our eligibility, we know which activities are qualified for the alignment assessment. To define alignment, it dictates that an eligible economic activity makes a substantial contribution to at least one environmental objective, doing no significant harm to the other environmental objectives, and meets the minimum social safeguards. With that, we can see the assessment is broken up into three different portions that have to be followed: minimum safeguards, do no significant harm, or DNSH, and substantial contribution. Now, an important note, all criteria must pass for that activity to be considered aligned. Failing even a single one will mean that that activity is not aligned with your company, but I'll get a little bit more into that later. And as for a visual, we can illustrate the following. Now, I mentioned that the workflow for the report itself is not explicitly defined in the EU Taxonomy, so companies are able to define how they'd like to go about the report. This is ESG Playbook's approach to an interpretation of that workflow. We like to start at the minimum safeguards, which is the highest level, work towards the do no significant harm sort of at the mid-level, and then finish with a substantial contribution, which is much more detailed and at the lowest level. This is actually quite different than how others have approached the taxonomy, where they normally start at substantial contribution, work through do no significant harm, and finish with minimum safeguards. But our interpretation allows companies to work at a higher level first, at the full organization for minimum safeguards. That means that if they fail the alignment assessment earlier, which isn't necessarily a bad thing, this means that they can qualify out of the assessment earlier. This will absolutely save time, and with months of work ahead, any time saved is incredibly valuable. Starting us off is the minimum safeguards. These would be the organization level criteria, so you'd only have to answer these criteria once for your whole company. They're focused on human rights, and the criteria are based on the below organization's requirements for policies on those human rights. We have the Organization of Economic Cooperation and Development, the OECD, the International Labour Organization, the ILO, and then the United Nations Global Compact Principles on Business and Humans, which is the UNGC Principles on Business and Humans. Now, assuming you've passed their minimum safeguards, you will have to respond to the criteria for the rest of the assessment. And if you were instead to fail minimum safeguards, you'd effectively have failed the rest of the alignment assessment, and you could skip the next two steps. The next step in our alignment assessment would be the do no significant harm portion. These criteria are for the sake of determining if the activity is actively working towards making is working towards minimum environmental care of at least not damaging the environment. Criteria are then based on a legal entity level and are categorized by environmental objective. So that means for every activity, for every legal entity, for every applicable objective, you have to respond to every criteria. Legal entities that have failed to meet even one criteria are exempt from the next step, the substantial contribution portion, as they've failed the alignment assessment. And coming up last is the substantial contribution. These criteria are for the sake of determining if the activity is currently taking steps towards bettering the environment. And criteria for substantial contribution are facility-based. That means for every activity, for every facility, for every legal entity, for every applicable objective, you have to respond to every criteria. Even more complicating is the fact that criteria can request compliance towards specific external assessments. These can have requirements based by region or by nation, and most likely going to need local consulting to meet said requirements. Luckily though, out of the 6 total environmental objectives, only 2 are applicable for the first year, this being climate change mitigation and climate change adaptation. The other 4 are undergoing criteria development and finalization, but until those are completed, they will not be applicable for the reporting year of 2023, where we use data on 2022. Facilities, of course, that have failed to meet even one criteria of the substantial contribution have failed the alignment assessment. But that doesn't necessarily mean that the entire legal entity has failed. We'll dive a little bit more into the distribution of passing and failing of alignment in our next step. So those are the 2 assessments we have to undergo to make sure that we are following the EU Taxonomy criteria, eligibility and alignment. With those done, we can start aggregating our finances and assign these statuses. To do that, we'll need to understand a couple more key terms and refresh a little bit on reporting deadlines. Some initial key terms are turnover, or net revenue, CapEx, capital expenditures, and OpEx, operational expenditures. These are how the taxonomy splits income and expenses, and how these are referred to as financial KPIs. And as a general refresher, the EU Taxonomy report is due when financial reports are being filed. So that means ideally, much before then, facilities and legal entities' financials have also been finalized, and this data becomes very important during this step. With those KPIs, we can assign statuses, and I've been using air quotes because status is not necessarily a taxonomy-specific word, because there's not really one to go with it. However, there are 3 defined as non-eligible, eligible but not aligned, and aligned. Non-eligible refers to the activities that were either not included in the EU Taxonomy, such as a high carbon activity, or an activity that does not yet have criteria. Non-eligible also refers to an activity that went through the eligibility assessment and failed, found out not actually part of our company. Eligible, but not aligned, refers to activities that were initially found eligible, but ended up failing the alignment assessment in some way. And aligned refers to the activities that have undergone all criteria and have passed and met those criteria. Now you'll take these 3 statuses, distribute them to turnover, CapEx, and OpEx for every legal entity in regards to the applicable activities. So that's 3 different data sets that we have to map together. There's a lot of data to keep track at this point, and unfortunately, it does get a little bit more complicated. So as an example, let's say we underwent the whole process with entity 1, maybe one of a few legal entities within our business. Entity 1 has 4 facilities, 3 of which have passed the alignment assessment, where 1 of them has failed. So how much of entity 1 would be aligned? And unfortunately, it's not as simple as saying 75%, where 3 are aligned and 1 is not. Alignment of a legal entity is dependent on the total aligned turnover, CapEx, or OpEx of the applicable entities in respective to the financial KPI. In our example, the total turnover for these facilities that is aligned equals to 70% of the entity's total turnover, while the facility that was not aligned has a turnover of 30% of the entity's total turnover. So entity 1 in this case would be 70% aligned, not 75% aligned. This information becomes vitally important when applying turnover, CapEx, and OpEx amounts throughout the year, as it will directly affect how much of your business is overall aligned, eligible, or non-eligible. So with all of that data managed, we can finally move on to the report building process. And relatively, report building is the easy part. However, it does involve some short to describe but difficult in practice steps. So by this point, we've completed our eligibility and alignment assessments for our entire business, effectively for all relevant activities for all legal entities. We've also compiled all of our separate legal entities' financial data, including their facilities' financial data as well. And ideally, all of those finances for those legal entities have been assigned statuses on each activity. We'll have to take the EU Taxonomy approved report template and designate data accordingly and ask for specific data points in specific fields, so that's what we would have to follow. Reports, however, are also based on organization and legal entity level, as well as split up by financial KPI. This means that a single legal entity will have to have a taxonomy report, a CapEx report, or a turnover report, sorry, a CapEx report, and an OpEx report. While the parent organization will then need to have an aggregated report of all of its legal entities for each turnover, CapEx, and OpEx. So each legal entity will have 3 reports. Reporting doesn't necessarily stop there, as there is actually assurance to consider. Although there are no EU Taxonomy specific assurance requirements, investors or non-regulatory stakeholders might require assurance to be taken towards the report. Also, there are certain criteria within the taxonomy itself that sometimes, such as some of the assessments, that sometimes require external assessments, which also may require their own assurance policies. So taking steps to procure supporting documentation is a good practice. And come the year 2025 with the CSRD, where you'll be reporting on data for 2024, there will be assurance on taxonomy reports. And that's it. We've gone over the EU Taxonomy at a high level, spoken towards the requirements and who's involved, and also gone through the specifics of how a report can be processed. But on paper, that's an explanation. Following this, I'd like to introduce Vasarė, who is currently working as an ESG consultant and has some direct experience with undergoing this entire process. Vasarė has worked with Northern Horizon Capital throughout their SFDR report, which then in turn is also required in the EU Taxonomy report. Vasarė, I'd like to hand it over to you to talk about your experience with that.
Thank you, Ian. So as I was introduced, I'm Vasarė. I worked as ESG officer in Northern Horizon Capital. Yeah, could I have a slide on, please? Thank you. So in Northern Horizon Capital, which is a real estate management company in Nordics and Baltics, and we have 3 funds, 2 funds in Nordics, healthcare facilities, and 1 fund in Baltics, real estate and offices, which is also NASDAQ listed company. And in 2021, we made a decision that all the funds are SFDR Article 8, and thus requires to disclose EU taxonomy during periodic and pre-contractual reporting. So starting from 2023, so this year, and because we are Article 8 funds, we are light green funds. We promote environmental and social characteristics, and we decided to go through the whole EU taxonomy exercise in the beginning of 2022. Next slide, please. Thank you. So in the beginning of 2022, you can see the timeline that we started our first phase. The first phase was basically to assess our whole 3 funds. So we treated them as separate entities, as separate companies, assessed them for EU taxonomy alignment. And in total, there were about around 100 assets, each fund with a different amount of a different type of buildings. And then the first phase was scoping, mapping funds activities to EU taxonomy, screening for alignment with technical screening criteria. Then we assessed alignment with minimum safeguards, allocation of financial KPIs, and reporting. So after actually 6 months, we had reports on EU taxonomy alignment for each fund. And at that point, we knew our gaps. what we need to do further. Next slide, please. Yes, so the first phase that took us 6 months was for substantial contribution and also assessing our policies and internal procedures for minimum safeguards and do no significant harm. The do no significant harm meaning for other environmental objectives, remaining 5 objectives. And in this case, we have decided to choose climate change mitigation as our substantial contribution criteria, and it was based on our general fund strategy to be a sustainable fund, sustainable company, and all our assets were new. Well, at least majority of our assets were new, had a high EPC rating, were really performing really well environmentally, or at least this is what we thought before we did a taxonomy screening. So taxonomy, so we chose taxonomy eligible activities, and all our assets were taxonomy eligible. So we had 100% taxonomy eligibility, so meaning that taxonomy applied to us, and we had to screen all our assets. And we screened all our funds and assets based on 7.1 criteria, construction of new buildings, or 7.7 acquisition and ownership of buildings, which is actually the main activity, economic activity that we have, and that's the main criteria we screened. For technical screening criteria for climate change mitigation. Then next slide, please. Yeah, so at that point we were full at the first pillar of EU taxonomy, so substantial contribution. So at that point we knew our substantial contribution percentage, which in turn would have translated to taxonomy alignment if we fulfill do no significant harm and minimum safeguards. And of course we thought that, you know, like do no significant harm gonna be easy, and minimum safeguards, human rights in Nordics is at a high level, so we have nothing to worry about. And actually took another half a year to fulfill the remaining 2 criteria. So to do climate risk assessment on asset level for each fund, so for each asset we have, and produce do no significant harm, basically climate risk assessment for climate change adaptation in our case. Because other objectives did not have, or still doesn't have, do no significant harm technical criteria. So only climate change adaptation. However, I just want to mention that our funds were actually screened for whole 6 objectives, even if at the moment it's only 2, but we screened in the future to make sure that, you know, we do no significant harm, and that for all 6, sorry, remaining 5 environmental objectives. And then we implemented also minimum safeguards, which is human rights. Actually, we had to implement a new policy, change our responsible investment policies and also implement many procedural changes in our company and in our relationship with stakeholders and partners. And it was very lengthy and costly process. It requires quite a lot of external help, and at that point we had there was no available technological solutions, so we relied on our internal resources and consultancies from various other companies. Yeah, so after a year of work, we had all 3 pillars. We have now all 3 pillars fulfilled, and we can claim taxonomy alignment, which we will disclose in our SFDR reporting in 2023. Next slide, please. So what we received is, of course, as I mentioned, is legal compliance, which was the main thing why we did EU taxonomy alignment in general, to be able to show our taxonomy alignment percentage for SFDR reporting. Then because EU taxonomy is the only really regulated and technical sustainability framework, we are aiming to reduce greenwashing. So it's a scientific and technical criteria that we are relying on as a fund, as a company, as a really trustworthy framework. And in this case, it was implemented in our investment decision processes, and we are screening all our investments and decision based on EU taxonomy. Then fund resilience and reputation. So because we chose to be Article 8 to have Article 8 products based on sustainable finance disclosure, we are really pushing towards sustainability. So we are not Article 6, which is brown fund, has no environmental objectives. We have environmental objectives, and we have to disclose our taxonomy alignment. So that's a really extra steps we are doing towards sustainability. And also because there are many climate risks and also sustainability risks, it's making our portfolio resilient and future-proof for legal and also actual environmental risks. Also, at the moment, for attracting investments, our clients and investors are mainly big pension funds, insurance companies, banks, etc., and they all need to report on EU taxonomy sooner or later. Thus, they're already asking us our EU taxonomy and SFDR status. So for us, it's basically to staying up in the market and not falling behind. And now green investments are getting more cash flow and interest from investors. So this is our ambition, is to remain market leaders in that and have high levels of EU taxonomy alignment. And also that's obviously in the future will be very attractive for investors. Next slide, please. Yeah, so for the future, we are planning, of course, to periodically together with other environmental objectives, and also staff training to teach investment team, also analytics, financial analytics, to use taxonomy alignment and to understand taxonomy requirements for assets is taking place. It's actually a very lengthy process again, because taxonomy is very difficult regulation and complex. It requires a lot of knowledge, technical knowledge, and it's ongoing process to train staff, to get people used to ESG as regulated requirements. And another thing what we are planning is to improve data collection process, because it's been manual and we used plenty of Excel sheets. So we are looking into automatization and digitalization, something like ESG Playbook is already offering. So to remove the manual work from people as much as possible. Another pathway we are planning to assess is look into EU social taxonomy, because our Nordic funds are social funds, and we see as social and objectives as important as environmental, and we are looking forward to see what social taxonomy will bring us. So yeah, that's all from me. Happy to answer all your questions. Thank you.
Thank you for that, Vasarė. And one final note before I hand this back over to Sonia to close us out with some QA for today, to go over a little bit of a summary of what we've talked about. So the EU taxonomy is complex, just as you've seen, and takes quite a bit of effort and time to meet those requirements, as you've just heard Vasarė explain. This report currently affects thousands of companies globally. The data needed is gathered from all forms of stakeholders, and each stakeholder needs to be educated on the requirements to provide the proper information for the reporting. And also by the taxonomy's nature, this is a continuous process that is constantly evolving. Reporting on 2022's data is a priority for this year, but that also means collecting data in 2023 for reporting in 2024 is probably even more important. And to Vasarė's experience, she mentioned this process took an entire year with the helps of all sorts of stakeholders and work. And this was done through lots and lots of Excels. Softwares can help solve a lot of these problems that were presented today during this webinar. Most of the work just in general, either that being the gathering of regulation data, gathering of financial data, conducting assessments, et cetera, they've been done in sort of DIY methods. These were, in a sense, just barely enough to make it through the report, but the DIY methods weren't only used because they could make ends meet. I mean, why would anyone want to navigate all of the legal documents, for example, gathering them and reading them and translating them, when a software would do that for them and present the criteria that's needed for the immediate question in an understandable language? No, DIY methods weren't used because that was the preferred method, but it was rather because the software solutions weren't available for the current requirements. As Sonia mentioned at the beginning, the ESG Playbook is a software solutions company that helps solve these pains, turning those DIY methods into more streamlined processes. We offer a wide range of ESG solutions, the EU Taxonomy, of course, being one of them, and all of our streamlined processes are across all of the products. So not just for the EU Taxonomy. However, I'd like to hand this webinar back to Sonia to close us out for the day.
Thank you, Ian. As a reminder, we are hosting a webinar for the SFDR regulation on February 2nd at 1500 CET or 9 a.m. Eastern Standard Time. Details are on our blog page on our website, www.esgplaybook.com. We will now open up the call to questions. Thank you.
I'm jumping back in because I saw a question that I actually wanted to answer. So sorry, as I read off of the screen to the side, can you explain a little bit more when we have a substantial contribution and when there's also a non-substantial contribution? I'm going to take this as an assumption of when we are going through the substantial contribution criteria, and then some of our facilities within a legal entity pass and some of our facilities within a legal entity fail. If we follow back within our example where entity 1, it was 70% aligned, that means the entity is then also 30% eligible but not aligned. So when we go to put in our books and our journals for that specific entity and assign it towards turnover, CapEx, or OpEx, 70% of that value would then therefore be aligned, and then the 30% of that, the rest of that value would then be eligible but not aligned. Which I hope answers your question. Because I'm here, one more, I can take that as well. I saw another on facility. When you say facility, do you mean any financial facility or not necessarily a real asset? So facility in this case refers to the location. This could be either a building asset or an operational building. In this case, Vasarė's experience mentioned that her substantial contribution criteria were based on her company's assets. So those buildings that her company was owning and was managing, that was something she was doing for every single one of her funds. In the case of a manufacturing company, maybe it's a building that you are working in operationally and you're manufacturing a certain product at that location. But I don't want to steal the question and answer show, so I'm going to let someone else take a couple questions.
I saw some questions regarding to the scope of the EU taxonomy. One question is, in the case of large organizations with 500 employees, what would be the situation of a company having registration in the EU as well as the UK, which is non-EU, with a large amount of total employees of 500, but not in the EU? Would this fall under the EU taxonomy? So I think at the group level, if your parent company is based in EU, then you are in the scope because the headcount is based on consolidation basis. However, if you are not if you are a non-EU company with 500 employees globally, then you are not subject to EU taxonomy reporting. But notably, the CSRD entered into force on January 5th, 2023. That indicates the third country non-EU companies will be affected from year 2028 if they meet the criteria. For example, the turnover in EU is over 150 million in year 2026 and 2027. And also you have subsidiaries in EU that are large companies or listed SMEs, which are smaller, medium-sized enterprises. Hopefully it helps. Another question is regarding the reporting. Can we exclude the EU taxonomy report if we have no taxonomy aligned assets not included in numerator? So I'm not very sure about the type of organization. If it's a non-financial companies, if you fall into the scope of an FRD or CSRD in the future, you still need to produce a EU taxonomy report. But you should only fill out the eligibility part, section A1, and the non-eligibility part, section B, in a template. The alignment portion would be 0. Let me see, there are some other questions regarding to the Article 8 fund. So if the fund is Article 8, but only promotes social characteristics, does it also have to align to the EU taxonomy? So the answer is no, because Article 8 funds allow the manager to invest in social and the EU taxonomy aligned and non-EU taxonomy aligned environmental objectives. And also they don't have to be obligated to make any sustainable investment. So that means, they don't have to disclose taxonomy alignment if you only promote social characteristics. There's another question regarding the timeline of the remaining 4 environmental objectives. So the question is, when are you expecting reporting on other 4 environmental objectives, both eligibility and alignment? When are technical screening criteria expected? This is a very good question. Actually, we don't have the answer. The only thing we know is the remaining 4 objectives already applies from January 1st, 2023. However, the technical screening criteria, which should be set out by the Delegate Act, is not published yet. We will closely monitor the legal development and keep you informed. You can sign up our newsletter or contact our sales. Once the Delegate Act published in the journal, so non-financial companies should start to report the eligibility to the 4 objectives. And from year 2024, so non-financial companies should also report the alignment as well.
I saw a quick question, Bella, if that's okay, if I can take these.
Yeah, sure.
There was a question regarding what software you're referencing or developing for the report. So this is ESG Playbook's own software for EU taxonomy. Those 2 videos that you saw were from our eligibility assessment portion of our EU taxonomy report builder. And then sort of tying into that, there was another question. Does your taxonomy tool also include integration of various simplification assumptions or self-developed approaches that would make it possible to make a decision on do no significant harm or substantial contribution in the case where data is not available. So yes, we do have guidance all along the way for the sake of providing the criteria directly to you. So a lot of the criteria is all legal talk. It's all laid out in different delegations, directives, acts, and annexes. So it can be quite taxing to sift through all that, and that does sort of get provided directly towards you. And sort of we've done a sense of sort of commonizing the language, but still providing the legal documents if needed to get more directly into it. I hope that answers. Well, I kind of took two questions, so I hope that answers both of those. There was one more. Is the EU Taxonomy alignment mandatory for SFDR reporting on Article 8 and Article 9? Actually, Bella would be okay if you answered that one because you're more on the SFDR side.
Sorry, can you repeat which question?
Is the EU Taxonomy alignment mandatory for SFDR when reporting on Article 8 or Article 9?
Yes. Yeah, for under the SFDR, both Article 8 and 9 funds have to report on their taxonomy alignment KPIs. So this is at the fund level. So, but for asset managers at the entity level, only if they meet the criteria of being a large public interest entities, then they will need to produce a taxonomy report. Okay, I think we are running out of time, so I'm gonna hand over back to Sonia.
Thank you all for joining today for ESG's Playbooks webinar. Please reach out to us with any questions you may have or how we can help you with your ESG reporting needs. Again, if you can see our emails on the page here. Thank you so much for attending, and goodbye and thank you.